Good morning, traders. Today is the 24th of December, Christmas Eve. Merry Christmas, everyone. We made it almost to the end of the year. It feels incredible, really, to be through this year. It's been a very interesting year, and if you've been following me for quite a while, or if you've been following me for the last couple months, you know that we have been safely protected, away from risk, running our trading systems efficiently. We've seen the MENT Rotational Modeling system climb back off of a moderate, roughly 2% decline. And now we're very close to turning positive for the end of the year, which will be fantastic because I can't wait to see what these hedge funds come up with. End of year results are going to look, in my opinion, are going to look wonky. I mean, you're going to be seeing minus 20, 30, 50% declines in some of these big institutional hedge funds, whereas my rotational modeling system, if you've been following it, has provided a very clear and accurate protection of assets and has been very safely navigating these crazy market trends. Okay, this video is the TTScanner Hotlist video. This is where we look for weekly swing trade setups and get kind of a feel for what the markets are doing, the market sectors are doing on a weekly basis. Let's go over this one. This is the core TTScanner core hot list. These are the core ETFs that we want to kind of follow. And what we're looking for here, ladies and gentlemen, very simply are new triggers. We have 3 new triggers right here. And what we're also looking for is general market consensus. So you can, if you followed me, you notice that these were all bearish and red about 4 or 5 weeks ago. Everything was really telling us that the market was not finding any real support and that there was no real indication of a trend change taking place. Now we're getting quite a bit of bullish in here. It's mixing back up. It's turning back to potentially into more of a sideways mixed market. We had a couple of older triggers up here. You can see these are 32, 33, 36, 45, and 49 weeks old. Now understand that these are almost really a year and a half or 2 years old. And you can see the profit in the trades here are 44%, 40%, 4%. And this is obviously rolled back over UUP, 24% and 41%. So these have been really strong trades that have lasted more than a year, almost 2 years now. And what we're looking at here, actually about a year, this would be about a year, sorry. What we're looking at now is these newer trades. So what are we seeing here? PBW, we've got a new short trade. It's up 10% already. Hasn't hit our targets yet. We've got fairly strong downward thrusting pattern. We've got a -5 on the bull-bear trend indicator. You're seeing this clean energy sector starting to really weaken. And this could be a very strong trade. This was 1 week old. It's a great trade, 10% in 1 week. It really is a week and a half or so old. Great trade setup. But look, again, clean energy is much, much weaker. We could see this really unwind as these clean energy systems are put to the test through this extreme cold winter, especially in the U.S. ARK Innovation Fund, new trigger. We're up 6.46%. This is a brand new trigger last week. We haven't hit any targets, minus 23.68 on the thrusting system, -7 on trend. Very, very strong downward trigger. Getting close to about $3 away, $3.30 away from our first target level. Remember, these systems provide target levels and a protective stop level. So understand that you can follow these. They're on a weekly basis. They're great swing trade setups. You just need to use smart allocation when you're trying to determine how to trade these. Watch my MENT Rotational Modeling System videos and understand that what you do is if you have hypothetically $1 million in your account and you want to protect it, what you do is you allocate X amount, which should be roughly 80% right now, into the MENT Rotational Modeling System. Then you would leave roughly 5 to 10% in a cash reserve, and that would leave you 5 to 10% for trading. And that's ideally how you want to break up your capital. Essentially, a larger portion of your safe, secure capital should go into the MENT Rotational Modeling System. A small portion should go into a cash reserve, which is going to help you for taking advantage of setups like these, which may occur on a regular basis for you to take advantage of short-term trade setups, discretionary trade setups, and then you would allocate a small portion, say 5 or 10% into actual trading. Now, out of that trading account, that 5 or 10% that you're setting up of your capital for trading, you would break those into 10 or 15 or 20 trading slots. So theoretically, if you had $100,000 broken into 20 trading slots, that would break down about $5,000 per trade. And that would give you the opportunity to trade efficiently without trying to become overly aggressive in trying to put more or less money into something. Ideally, ladies and gentlemen, what we're looking for is the MENT Rotational Modeling System to manage a bulk of your capital, and then these trading systems to be handling a smaller percentage of your capital. Now, understand that when the systems become more aggressive, when the markets are clearer in an uptrend, we may be allocating more towards trading, which is why you have that cash reserve. Right now, the MENT Rotational Modeling System is the safest, most secure way to protect the capital. And as we move back into a more defined trend, we may become a little bit more aggressive with regards to our trading capital. But right now, we're staying very safe and secure away from risks. Okay, so now the ARK Innovation Fund is moved lower. It's got a very strong downward trend. The ARKQ, Technology and Robotics, is also short. New trigger, 3.88%. It is moving fairly strongly to the downside. These will eventually bottom, ladies and gentlemen, but as long as that ESG, that green energy, that alternate sector is under pressure, you're going to see these downward trends. Could be fairly short-lived right now, but it might take until February, March, April, summertime for these things to actually bottom. And of course, the last trigger here is HAIL, which is Smart Mobility ETF. And of course, you can see what we're seeing here is clean energy is short, innovation is short, technology and robotics with ARKQ is short, and smart mobility is short. What you're seeing here is, again, technology, ESG, green energy is really losing its shine. And this is because what you're going to find is green energy is great in perfect weather conditions, but not so great in extreme weather conditions. You're also, again, like I said, starting to see some real bullish triggers here. Now, these are flat, weaker. We're not seeing any new trends. These may be good opportunities. Watch for your target. My advice is the markets are seeking out some sort of a base or bottom right now, so you may not see target 2. You may only see target 1. Be aware that in this type scenario, if you're taking these trades or looking to take these trades, I would be looking to pull 60 or 70% out of target 1 and move my stop effectively to protect the trade. This way, if you get to target 1 and you grab a quick little profit, you can lock in your gains and eliminate potential risk to the downside. Okay, the next, let me find out where we need to go to get to the next one. Is it over here? Where is it? Wow, can't seem to move it. All right, let's go over here and open this one up. There we go. Here we have the core inverse list. The core inverse list is the opposite of the core list we just looked at. You can see that everything is bearish. So what we have is a core list, which is our master ETF list. Then we have a core inverse list, which gives us long triggers in a downward cycle trend. You can see that the inverse list is primarily bearish. We got 2 flat triggers here. The Dow Jones Ultra Short went flat, and the 3X Bear HIBS High Beta Bear 3X went flat. We are long the MSCI Emerging Markets. It's been 35 weeks in the trade. We got 11% already hit the targets already, and no other new triggers. But what this is telling you here, ladies and gentlemen, with all this bearish and distribution, is that markets are changing direction or potentially changing direction. When the core list is turning more bullish and the inverse list is turning more bearish, what you're actually seeing is that the markets may be setting up into a new potential bullish trend for the U.S. Major markets, which means these inverse ETFs could be moving into bearish trends and short signals while the primary ETFs move higher. Very interesting setup taking place. Okay, next we're going to go to the TTScanner list. This is the main list. Let me resize this a little bit. Drag this over. All right. Now drag it over a little more. There we go. Hopefully you can see the... There we go. Okay. The core list ETF, this is the TTScanner, what I call main TTScanner page. This includes a whole variety of symbols here. And you can see we're getting mixed signals, okay? We're getting bearish, bearish, bullish, warning, bullish, bullish, accumulation, couple of mix, some accumulation here in semiconductors and RWX and XLU. We have no new triggers. We just have these older triggers. We have the thrusting system is turning bullish. You can see these positive numbers over here, but we're still in a bearish downward trend. The markets are essentially flagging out right now. And you'll see that. I've been telling you that for months, actually. But the markets are flagging out in what appears to be the end of a wave 4 correction, potentially building a bullish wave 5 impulse wave to the upside. We have flagged out. We have seen some downward rotation over the last week or so. And we're moving into the end of the year, which I am seeing some support building in the markets. Maybe we're going to see some volatility over the next week or two, but by January 4th, 5th, 6th, 7th, and 8th, I think we're going to see a pretty big rally phase. And that could move the markets back into an early stage rally. We are not seeing the MENT Rotational Modeling system confirm this yet. We are seeing some signs that the markets are changing. And what I think is what's taking place is a reflation rally. I mentioned that to you earlier. But again, what we're seeing here, ladies and gentlemen, is a bit of a transition in the markets, but we're not seeing any great triggers yet. So really what I want you to be aware of is this is a volatile sideways correction, reaching an apex, a flag apex in the markets. And this is not the time to be trying to bet the farm on anything. This is the time to be waiting for January to come, waiting for the markets to trend, see what Q4 looks like, potentially look at some opportunities in the market. And as I have been mentioning to you for weeks, I think we have some real strong opportunity in technology. Okay, technology has been really beaten down. You know, I'm sure you're following Tesla and others, but I had mentioned to you about 2-3 weeks ago that, you know, I have already started taking what I call token positions in certain technology companies. I'm going to let you determine what you want to take a look at, but look at these semiconductors is in accumulation. Real estate is in accumulation. I would probably stay away from real estate right now. Utility sector is in accumulation. Medical devices is in a bullish trend. We come down here, infrastructure, healthcare is in a bullish trend. Consumer staples is in a bullish trend. Global tech is in accumulation. Miners, very strong move potential in miners over the next couple of years, but try to buy on a pullback with some of these. And again, look at these, biotech is in a bullish trend. Biotech is in a bullish trend. You have some opportunities here. You need to be aware that, you know, only certain sectors, like, for example, healthcare, biotech, defense, infrastructure, utilities, consumer staples, these are what may be early performers for 2023. And that's why, again, it's fairly safe to get into a very small token position. And when I say that, I mean it's almost like, you know, a couple $100 or maybe $1,000 or $1,500 into some token trades just to anchor yourself into a position to try to watch this into 2023. But do not become overly aggressive with these trades yet. We're not seeing any big trends yet. Lastly, We'll go to the value hot list. The value hot list is very tiny because we got a lot of symbols on here. You can see we've got a couple of mixed signals here. Let me see where we're at. We have to move this a little bit. There we go. So we've got Salesforce. We've got a new short 1 week ago, already up 1.27%. Have not hit our targets yet. We have a couple of triggers here. Travelers, 7 weeks old, up 4.16%. Have not hit targets yet. Merck, MRK, is 6 weeks old. It's up 13.56%. We've already hit our first target. This means, ladies and gentlemen, you should probably be looking, if you took this trade, to exit or be exiting 65, 70, 75% of the position, leaving a very small trailing with a protective stop near 97.02. It's currently trading at 111.86. Our entry was 98.50. This will move up as we move into longer trending. Next one is Amgen. We are 6 weeks into the trade. We're at minus 1.58%. We did hit our target. It looks like a couple weeks ago. Stop is at 263.25. Currently, it's at 263.92. Very close to getting stopped out on this right now. Smuckers. Smuckers has been actually generating quite a few triggers here. This could be a really solid reflation trade. 4 weeks old, up 10%. Already hit our first target. Stops at 141.94. Currently trading at 159.44. That is above our first target, almost to our second target. Smuckers has really been a great little trade here. And then we have Caterpillar. And Caterpillar would be a potential reflation of the U.S. economy type of trade. Understand that, Intel, Hasbro, what have you, Travelers Insurance Company, Merck, Travelers maybe, but Merck and Caterpillar would be actual reflation trades. So you can see when the markets come back, when consumers come back, you will start to see certain symbols move back up the list, okay? And again, what you'll see is likely Walmart, Visa might start moving up the list as credit card are being used. You'll see potential Johnson & Johnson will move back up the list, and others, general staple products. So SMJ Smuckers is actually a pretty strong trade here. And then, of course, Caterpillar is another consumer staple type product, industrial use type product. And you can see we've got a new trigger on that, 2.55%. Hasn't hit our targets yet. And we've got two flat trades here, IBM and McDonald's. This is likely because food costs and the fact that, nobody really wants to go out and spend $50 for a couple of burgers and some fries at McDonald's. It's actually getting to the point, crazily enough, where, you can go home and make some really good home meals instead of going out and shopping. And that's because of inflation right now. Costs are high. Cost of doing business is high. Labor is high. Rents are high. So, the actual benefit of going out to eat is getting weaker and weaker. It's not the same deal where you can go out and, we've noticed it out here in California. You go out and spend money trying to get a couple of burgers for 3 people. You end up spending $45 to get burgers. And I hate to say it, but I can go to the local store and buy steaks and asparagus and whatever and walk away with maybe $35, $40, and I'll eat better cooking up some steaks than I will burgers and fries and sodas. So that's one of the things that's taking place right now. But generally, you can see we're getting some mixed triggers here. We're starting to get bullish accumulation. So pay attention that we're going to start to see some real potential here in the market, I think. Come end of January, I think we could be looking at the start of a reflation trade. In fact, let me see if I can come here and here so you don't. Again, the hard part about doing all of this is making sure that you see what's important. This is the S&P, and get rid of this window. And you can see here, this is one of my main charts for the S&P. We'll go to weekly. And we only have a little bit of time left into the end of the year. This was what I drew last week. I'll get rid of this. And we will try to take a look at the scenario here of this particular trigger here, moving up and potentially moving into potential new all-time highs by the middle end of 2023, maybe. So understand that if the Fed starts to become a little bit more adaptive to market trends, we could see this deep, deep low, which is very critical support. This green area here is extremely critical support. The market has held up very well. This is a very solid contraction and retracement down here near this support line, this dashed green line. And I believe we're looking at the beginning of a wave 5 move to the upside. Wave 5 move to the upside. Let me come over here, shrink this down. Wave 5 move to the upside, ladies and gentlemen, would last until 2027, 2028, which means that we would be, we're not even there yet. No, I'm going to move way over here. Okay, 2027, this is 2025. But anyway, let me come in here, and what we would be looking at potentially is a reflation trade, potentially back up to near all-time highs by the middle end of 2023, maybe up into some new all-time highs, stalling out a little bit, and then possibly moving back up into the potential of another 20 to 30% upside move, maybe a bit higher, especially if we get into some easing Fed into 2026, 2027, which is where we would end up seeing a potential for a broader decline in the market. When I say a broader decline, my cycle analysis suggests that 2027, 2028, as you're seeing back over here where I've marked it, this is where we start to run into some real pricing concerns. Okay, so let me get rid of some of these and try to redraw this and explain to you that the deflationary cycle that's taken place here will unwind. And I'm going to try to draw this in a more realistic standpoint. Possibly something like this. So we would essentially be looking at an A, B, C, D, E, wave 5, pullback after breaching to new all-time highs, into a slight pullback, maybe down into this area, which would be kind of a bear trap, as people would think, oh no, here we go again, collapse back down to these levels. And then we might see some sort of a blow-off phase, A, B, C type peaking way over here. And this would be our blow-off top up to new highs near 2027, 2028, and that may put the S&P 500 up into this 68 to 70, call it 100 area. And this would be our real ultimate peak potential up here. And I believe this is where we are going to see the markets attempt to stall and top, and that's this peak back over here, which is where we're going to possibly move into an excess phase formation where we flag out, break below that, try to find some support, and then possibly break downward. And that's going to be, we'll see how the markets look and what takes place back over here when this sets up. But understand that this is an excess phase peak. It's basically a 4 to 5 stage pattern. This is what we're dealing with right now, okay? We are dealing with this type of a pattern here, and an excess phase peak comes into play very common. So let me show you here that an excess phase peak can come into play and fail. So here's an example here. This is 2016. What we had here, we had an excess phase peak. We had and I'll move this over here, draw this. So we had this rollover. We had this flagging formation here. There's the excess phase peak rollover, the initial base bottom right across here. The flagging, the breaking down of the flag, it came back, retested these levels, found support, rolled back upward, and as soon as we closed right here above these highs, that was the end of the excess phase peak pattern. So this is an excess phase peak pattern that failed to roll downward, okay? What happens here is we get the pattern, we get the setup where we roll to a new high, we roll down, establish support, we flag out here and here. Then at that point, we're expecting the markets to roll downward, retest this support. If it were to have moved downward and set up a base level, then we would move sideways into basing, maybe many months or years, and eventually break downward. Now at this point here, it can move higher and break the pattern, or at this point here, it can move higher and break the pattern. So understand, this is wave 2 or phase 2, and this is phase 4. Now phase 5 is this downward breakdown, okay? Oops, yeah, that'll work. Phase 5 is this downward breakdown. This is where we see the move to an ultimate low, the actual crisis, fear, whatever you want to call it. This is the move to an ultimate low where we're trying to get to a bottom. And this is a unwinding of capital excesses. When it fails, what happens is we get a pullback, we get a weakening of trend, and then it'll fail back to the upside and start taking out new highs. Now, if I get rid of all of these, make sure I'm getting rid of what I want. Oops, I wanted that. Get rid of that, get rid of that, get rid of that, and that. Okay, I'm semi back to normal. Now we come over here, we reset the auto scale, and we take a look at this. Okay, now you can count this as a flagging formation here. I'm actually counting this as the flagging formation with a double bottom set up right here. So the way I'm seeing this excess phase peak is rally up to here, rolling down to here, setting up our flag right here, the big pullback, rolling back down to a double base bottom right over here. Now we're rolling over here to the upside. If we were to get down below this level on a strong selling price, I would say, holy moly, we're in a big unwinding phase. Look to protect yourself. This is going to take many weeks or months or possibly years to find a bottom. If we rally back up above these levels here, we are going to appreciate into a new upward price cycle and attempt to take out these previous highs, which means that we are in this sideways range. As long as we stay within this sideways range, the markets are trying to actively seek out new support or weakness, and this is why we need to be aware that there is no real opportunity yet until we have a clear definition of some kind of an upward or downward trend. Now, the markets could, over time, move into tighter and more narrow channels, but we have to see this play out right now. Right now, this is our flag peak, our wedge peak here, our flag phase 2 peak. This is our phase 3 bottom, which is setting up a potential for a phase 4 down here. If this were to break down here, let me come in here and show you that if it were to break down, okay, we would be looking at this. So hypothetically, if it were to come from this area, it would break down, break below all of this support, potentially try to find some support back over here, flag into a very weak pattern, and then maybe break down in 2023 or 24. That's what would happen in a broader breakdown structure. And this pattern here, this sideways rotation, could take a couple of weeks, could take a couple of months, maybe upwards of 2 years. Okay? Whereas if we move out of this range and get above this area into early 2023, then the next phase would be to take out the all-time highs, briefly stall back out of it like I showed you before, maybe come back down into this area, and then potentially start to move back up again, which would start a new appreciation phase to the upside. So this is, again, ladies and gentlemen, why we need to stay cautious, wait it out. That's the bottom line. There's no reason to try to force the markets to do anything. It's like standing in front of a freight train trying to argue with it. At this point, we need to be smart. We need to trade what's in front of us, be effective about what we're doing, and wait for some clear direction of the market, because it could go either direction right now. And because there is no real clear trend, we are going to sit and wait out the next phase of the markets as I get rid of some of these. Now I'm going to leave these for the next video, and I will leave you at that. Have a great Christmas, everyone. Remember, the markets give us opportunity every day. The smart thing to do is not try to force the markets, not getting married. And I keep reading these things on the internet. I want to tell you, I can't tell you how many people right now are, betting this thing is going to break to the downside or the upside. I read something the other day on a Reddit post. Somebody's account was $1.4 million upside down on options trades. I mean, there's a lot of people right now that are just betting the world that the markets are going to move. If you want to survive the markets, what you want to do is wait this thing out. Play smart. Wait it out. Opportunity will come. I promise you, in the next 2, 3, 4 years, opportunity will come. But right now, you want to wait it out. Stay safely protected in cash, a little bit of metals, maybe some junior miners, maybe some token positions in some technology or consumer staple or biotech or healthcare. But what you want to do is wait this sucker out right now. We need to see some more clarity, and it'll probably come by February, March of next year. All right, guys, have a great Christmas. Talk to you soon.